Hello students, this is Professor Vicente Sagai. Welcome to my class. This is the presentation of part 5 of chapter 5, hopefully the last part of chapter 5 presentation. Chapter 5 deals with evidence and documentation. This is where we left off in part 4, substantive analytical procedures, decision process. So what are we talking about here? Recall we said that whenever we are able to use analytical procedures to test account balances, we need to take advantage and do so because it makes for efficiency. So what are we talking about here? In other words, you spend less time if you're able to use this approach to test account balances. So let me give you an example here. So on the income statement, we have revenues, we have expenses. One of the expenses is salaries and wages expenses for $503,000. Okay, so $503,000 is salaries and expense. Okay, now the auditors have determined that the internal control of the entity is effective, meaning it is well put and is well implemented. So, to the extent in which we can use analytical procedure to test account balances, like we said, we need to do so because it saves us a lot of time. In other words, this is a shortcut approach, okay? And it could be very effective. So let's take a look at the overview of the auditor's decision process for substantive analytical procedure. So here we go. So the salaries expense, $503,000. I have two different ways of testing that account balance. One approach would be to test it in detail. Okay, that would be one approach. Another approach would be to use a substantive analytical procedure. All right, so like I said, the latter is more efficient than the former. So let's take a look at the former using the first approach, which is substantive test. Substantive test, meaning I'm going to go ahead and ask for timesheet of all the employees, the contract to see how much each employee is being that the company said that they were going to pay the employee. I'm going to ask for the payroll records. I'm going to ask for canceled checks. I'm going to ask for the payroll related reports that we send to the government, the quarterly report like 941, 940, so on and so forth. I will gather all that evidence, analyze them, and I come to the conclusion that, yeah, salaries expense is actually $503,000. So salaries expense is properly recorded in accordance with GAAP. So I jump to the conclusion and I move on to the next area. So that is one approach. Another approach is to use the substantive analytical procedure. In other words, we are using analytical procedure to test account balances. So take a look at the example that we have here. So we indicated 10 employees, 50K salary a year for the average employee. So I do the math, 50,000 times 10, that gives me $500,000. So I figured out that their salary expense should be in that ballpark. So now let's take a look at the overview of the decision process. So when you are using substantive analytical procedure, we are asked as an auditor, first of all, to develop expectation. So if you can see here, you have to take a look at your PowerPoint on your laptop. So we develop an expectation. So in this case, my expectation is, since I know that there are 10 employees and the average employee makes $50,000 a year, so my expectation will be $500,000. So number 2, define a tolerable difference. In other words, how much difference is the auditor willing to accept? In other words, difference between what you expect and what they actually record. So that is number 1. We develop an expectation. So our expectation is $500,000. Number 2, we define tolerable difference. So our tolerable difference is $5,000. So give and take, plus and minus, if the salary expense recorded is plus minus $500,000, we are willing to tolerate it. So the third thing is, we compare the expectation to recorded amount. So what is the expectation? The expectation is $500,000. The recorded amount is $503. So there is a $3,000 difference. Now, is the difference greater than the tolerable difference? So the difference is $3,000. The tolerable difference is $5,000. So the difference is less than the tolerable difference. Excuse me. Is the difference greater? No, the difference is $3,000. It's not greater than the tolerable difference. Therefore, I will accept. Is the difference greater than the tolerable misstatement? No, the difference is not greater than the tolerable difference. So no, we accept the amount. So even though we we accept which amount? That is the $503,000 that management recorded as salary expense. We accept it. If the difference is greater than the tolerable difference, so if the difference, for example, was like $20,000, which is greater than the tolerable difference, then we need to investigate the difference. By the time you investigate the difference, there might be some authentic reason why the difference is significant. For example, 10 employees. Let's assume that half of them were actually employed in the middle of the year. Then the numbers are not going to play out as you anticipate. So you investigate the difference, you consider the pattern, trends, relationship, and possible causes, okay? Are explanations and corroborative evidence adequate? Yes, then you accept. No, then you conduct more tests and document your result. Okay, moving along. We just talked about this. Develop an expectation, okay? Auditing standards require the auditor to have an expectation whenever analytical procedures are used. An expectation can be developed using a variety of information sources such as financial and operating data, budget, forecast, so on and so forth. All right, define a tolerable difference. We just talked about that, okay? How much difference is the auditor willing to tolerate, okay? Then you compare and investigate. You compare the expectation to the recorded amount and investigate any difference if it is greater than the tolerable difference. Investigate differences for risk assessment and final analytical procedures. So we said final analytical procedures require at the beginning when we use analytical procedure as part of our risk assessment procedures at the beginning when we are doing the planning, we really don't need evidence, because at the beginning, for example, if we compare previous year financial statements and this year financial statements, we are just looking for any unusual significant differences that might bring our attention to one area or the other that we might want to pay close attention to. So at that point, we are really not into digging evidence and so on and so forth. But for the final analytical procedure differences, evidence is required so that the necessary adjustment can be made by management. So we have different ratios here that we can use for our analytical procedures. Like I said, we have different types of analytical procedures or different approaches for using analytical procedures. We can have reasonableness analysis, ratio analysis, trend analysis, so on and so forth. So that is the conclusion of chapter 5.